What's going on, everybody, and welcome back to Exploring Investments with Justin. And in today's video, I'm going to be talking about a company called Cloudflare, and this was a requested stock analysis from one of my subscribers. Now, Cloudflare is a pretty high growth company, and I'd never really heard of this one until I saw it in the comments section, but I'm definitely glad that you brought this one to my attention because it does look like a pretty interesting investment. And be sure to hit the like and subscribe button because it does help out the YouTube channel. And let me know in the comments section what your thoughts are on Cloudflare and what companies you want me to cover in my next video. So without wasting any more time, let's jump right into it. So looking at Cloudflare's business overview, they're on a mission to help build a better internet by building a global cloud platform that delivers a broad range of network services while making them more secure. And they're doing this by enhancing the performance of their business critical applications while eliminating the cost and complexity of managing and integrating individual network hardware. And as of today, about 13% of the Fortune 1000 companies are paying Cloudflare customers. So basically what they do is they provide an all-in-one cloud and cybersecurity platform. Now, if we look at their stock price, we can see that they're trading at just around $37 a share and is up over 100% in the last 6 months. And they even traded as low as $18 back in January. So already the market cap of this company is 2x this year and now sits at just over $11 billion. Now, I know many people haven't really heard of Cloudflare, but they are actually a high growth company, and even Wall Street has recognized this, with analysts expecting Cloudflare's revenue to grow by 36% this year and another 31% in 2021. And analysts are projecting their revenue to eclipse $500 million in 2021 as well. Now, typically I'll consider any company that's growing either revenue or earnings by more than 15% a high growth investment. So with their annual revenue over the last 3 years growing at a compounded annual growth rate of 50% and the number of large customers growing at a compounded annual growth rate of 68%, I would definitely consider this a high growth stock. Now, the large customer growth, in my opinion, is going to be the driving force behind their revenue and earnings growth because these are companies that are paying more than $100,000 in annual revenue. And in the next slide, we'll see why this customer growth is so important. Now, the last thing I wanted to point out from this slide before moving on is that they're currently achieving 77% gross margin. So a lot of their revenue is falling down to profits, or at least will be eventually, and we'll get into that later into the video. Now, this high gross margin is what makes tech stocks so valuable because their gross margins are so much higher than traditional businesses that have to produce and manufacture physical products, which requires production plants and workers. So this is definitely an added benefit that they have over 75% gross margin. So looking at this next slide, we can see that in their latest quarter, they grew revenue 48% year over year, which means they are showing no signs of slowing down that high growth. And the thing that's so important about their customer growth is that they are getting 100% of their revenue from subscriptions. Now, the amazing thing about subscription-based revenue is that you can always count on it because it's always going to be coming in, whether it's on a monthly or yearly basis. So as long as they continue to innovate, they should be able to hold a steady user base with the customers that they already have and will continue to gain. Now, with the whole global issue going on, we have seen a massive shift as companies move more and more data and information to cloud networks, especially as companies move to a work from home environment. And with this increased usage of cloud services, this requires increased cybersecurity. We've seen it happen way too often that a large tech company has a data breach that can end up costing billions of dollars. So this new way of working will be very beneficial for companies like Cloudflare that can provide data storage while maintaining a high level of security. So if we look at their financials from the most recent quarter, we can see that from a balance sheet perspective, they are a good, healthy company with more than $800 million in total assets and only $150 million in total liabilities. So this gives them a current ratio of more than 5, which is really good because that means that they have 5 times the amount of assets than they do in liabilities. And whenever you're looking at a company's balance sheet, you always want to have a current ratio greater than 1 because anything less than that indicates that they have more debt than they do assets. So to have a current ratio greater than 5 means that if worst case scenario, they lost all their customers tomorrow, they would still have enough to pay off any debt the company has. Now, if we turn to the earnings report for Q1 of this year, we can see that revenue grew by 50% year over year. However, their net loss has doubled in that same time span. Now, the good news is that the cost of revenue only increased by $6 million, so the cost of acquiring customers is growing at a slower rate than revenues are. And the reason for the increase in net loss is because they are spending significantly more on sales, marketing, and research and development. And like I mentioned before, their research and development will be crucial to keeping existing customers that they've already acquired. So I do expect this number to grow as they make more revenue and continue to innovate in a rapidly changing industry. Now, even though they're not profitable yet, they have given investors their path to profitability. Now, what we can see here is that they are hoping to reduce their long-term sales and marketing expense as a percent of revenue down to about 27%, which is half of what it is right now. And they're also working to get their overhead expenses down to just 10% of their total revenue versus the 25% that it accounts for currently. And we can see that they are working towards these goals because they have been able to reduce their overhead from 31% to 25% while reducing their operating margin from negative 30% to negative 16% with the hopes of getting operating margin to more than 20% in the long term. Now, I do think it will be important for this company to reach a point where they are profitable, and because they are losing money right now, I would put them into the speculative category more as a high growth, high risk investment, because the future of this company will depend on its ability to plan and execute. So as you can see, Cloudflare is growing their revenues at a pretty high growth rate, and if they can continue to do this, then I do think that their stock's value will go up over time. And because they do have significant more in assets than they do in debt, I do think that this is a pretty good investment, because like we've seen, a lot of companies are starting to move to a work from home environment, kind of like Twitter, who announced that all of their employees can work from home. So I do think Cloudflare will benefit from this shift in the workforce, and their stock price will reflect this over time. So I would definitely do your research before you decide to invest in Cloudflare. And to be honest, after looking into this company, I do think that they have some potential. And if the price reached about $30 per share, I could definitely see myself starting a position in this company. So be sure to let me know in the comment section what your thoughts are on Cloudflare, and let me know if there's any companies out there that you want me to cover. So thank you guys for watching, and I will catch you on the next one.